All right, let's go ahead and get started here. I'm your host, Dan Handford, one of the managing partners also with a group called PassiveInvesting.com. And that is actually this screen right here. This is our website. If you want to find out more information about us, you can go to PassiveInvesting.com. Our portfolio value is a little bit more than 21 million. I'm not really sure what's going on there. Maybe there's a little calculation error here. Let me see if I can refresh my screen and see if it changes. There we go. That's a little bit different. Somehow there must have been a little error because it sat there a little bit too long. But we've got a number of experience in our background. Got lots of different doors, lots of assets under management. But if you want to find out more about us, about me, you can go to this Meet the Team link here at the top and click on my name here, Dan Handford. We have a good team here of about 15 people that are working with us now. And if you're interested in joining us on some of our future opportunities and offerings we have available, you can click on this button on the top right-hand corner that says Join the Passive Investor Club. And when you do that, you can fill this form out, let us know that you're interested, and one of our team members will reach out to you, discuss your investment goals, and see if you're the right fit for our group. We do have a couple of current offerings available. We have our real estate debt fund that we have available, and we also have our property that we're raising funds for right now, which is a 506 Charlie, open for accredited investors only. It's called Ascend Waterly. So you can click on that under our current offerings to find out more information. If you'd like to join us, that particular asset is projected to close the first full week of July, so the week of July 5th, 2021. So feel free to reach out to us if you have any questions. Let's go ahead and dive into the topic for today, which is about real estate syndication. Oh, one more thing I forgot to mention. I know I mentioned this a little bit before we got the webinar started, but those of you who have not heard about it yet, we do have an event coming up this weekend, which is the Multifamily Investor Nation Summit. It is a live 3-day event for multifamily investors from all around the country. We'll have over 50 speakers, several hundred attendees that'll be with this. It's a 3-day event, all online, all virtual. All sessions will be recorded and made available to those who register. So you can go there right now. Tickets are only $197. So you can go there, check out the speakers. At the bottom of the page, we have a list of all of the sessions, each room, and the different topics that are going to be available for you at this event. So it's an event that we've been doing for a couple of years, several years now. It's actually our 6th event that we've done. And so you'll enjoy coming here and learning. And anybody who's anybody in multifamily investing is going to be here at this event, and we're going to be participating at this event. So make sure you go there, check it out, and register for the event. All right, so let's dive into the topic for today, which is these 7 reasons not to invest in a real estate syndication. And for those of you who have been following us for a while, you know that we actually do like syndication. So I want to share with you some reasons why maybe you should not invest in a real estate syndication, and how to protect your capital and how to avoid placing capital with the wrong operator. Because at the end of the day, the operator is going to be one of the main things that is going to be a good thing for makes the project itself be a go or a no-go project, right? So a lot of these things that we're going to be talking about today are going to be things that you want to watch out for, whether it be in the underwriting or with the operator's background and experiences, to make sure that you are invested with the right group. My wife and I actually are investing with outside groups outside of our own passive syndication group, which is called PassiveInvesting.com. We do invest in other LP positions, and we have roughly about 41 different LP positions with about 15 different operators around the country, and we have vetted dozens more. And so this kind of list of 7 reasons why you should not invest in a real estate syndication are from our experience in vetting these various operators. And so I do have a question coming in here. Wonder whether I can invest actively or passively with a self-directed IRA, checkbook IRA, or solo K funds. And what are the limits there? What limits are there to being an active or a GP? So when it comes to a self-directed retirement account, I know this is I got jumped ahead with some questions, but I wanted to touch this on this for you, Mark. With a self-directed retirement account, you're not allowed to invest in your own deal as a GP. So we have a lot of people that are well-known syndicators in the space that have done hundreds of millions of dollars in deals, and they can't use their own self-directed retirement accounts in their own deals. So they actually have chosen to invest with us, right? Which is great for us to be able to see that, to be able to have that, but it doesn't allow us but these self-directed retirement accounts don't allow us to invest in our own deals. So we have to make sure that we're investing that capital in a deal that we do not actually own and we do not actually control. So when it comes to that, that's the limitation that the self-directed guidelines have with the IRS and those guidelines. So if you don't have a custodian, we can certainly recommend one to you. We have a couple of them that we work with, and we can make some referrals to you. So reach out to us. We'd be glad to help you out there. So let's go back to the topic at hand here, which are these 7 reasons why you should not invest in a real estate syndication. So let's first go over the topic of maybe why you want to have an operator that has more than one managing partner. The reason why this is important is that if you have an operator that only has one managing partner and something happens to that partner, then you're going to have a harder time trying to get access to your capital and various things like that. And so I always recommend at least 2, preferably 3 different managing partners that are not related, right? You don't want to have like a husband and wife. Oh, there's 2 operators. No, it needs to be 2 unrelated people, right? That doesn't mean you shouldn't invest with a husband and wife team, but you want to make sure they at least have another managing partner at play there. So what happened about 2 years ago now with somebody that I had met at a mastermind event that I was at. They mentioned how they had brought in $200,000 of their own capital and convinced a friend of theirs to bring in $200,000 of their capital into a deal. And what happened is about 6 months into the deal, the operator went ghost on them, and they couldn't find the operator. They couldn't try to. Their money was still there. The property was still there. It was still cash flowing, but they couldn't get access to any of the cash flow because the property management company would only talk to the operator, but the operator could not be found. And of course, in the clauses of the operating agreements, you can get access to the capital or kick out the operator if you can, but you have to go through an arbitration first. Well, how do you arbitrate with somebody that you can't find? And so they've been going through this kind of court battle to try to get their money back and their capital out because they can't find the operator. Now, it's possible that the guy ran off or whatever, but he left the money. So like, why would he do that? But it's also possible that maybe he went on a trip somewhere, like maybe in Mexico or some other country, and maybe he slipped and fell hiking and he died, and they don't even know where the guy is. And who knows, right? So you always want to make sure that you have multiple partners. Another reason is let's say that you have 3 managing partners and all 3 of them jump on an airplane together and they all go down. Well, that's going to be another problem too, right? So you want to make sure that there are some contingencies in place where not all 3 managing partners are on the same airplane at the same time, right? Because you want to make sure that there is somebody else there that can manage everything if for some reason somebody goes away. So that's a big thing you want to keep an eye on, is that you don't want to invest. So this is number 1, do not invest with a group that does not have at least 1 managing partner at the helm. Now, the opposite of that could also occur where you have too many managing partners. That's why I say 2 is probably the minimum, 3 is ideal. Once you get to about 4, 5, and 6, that's, I guess, to be like too many cooks in the kitchen, right? So that's why I think that sweet spot is really kind of around that 3 mark. You also want to make sure that you do not invest with an operator that does not have a successful background in business. Now, they might know how to run a business, but we all know that people that have run businesses, but they've run them into the ground, right? We don't want that kind of an operator. We want to make sure we have an operator that knows how to run a business. They know how to put in systems and procedures and processes in place, set certain KPIs in place to make sure that if they need to pivot, they can pivot whenever necessary. And then the other thing about the operator is, this is kind of number 3. So number 1 was you need to make sure that you do not invest with somebody if they only have 1 managing partner. Number 2 is making sure that you do not invest with somebody if they do not have a successful background in business. And then number 3, you want to make sure that they are full-time in the business. There's a lot of part-time syndicators out there that are trying to get started. And it's my opinion that if you're a part-time syndicator, you should be joining somebody else's group to help them, not try to do it on your own, because this is a big responsibility to take on millions of dollars of capital from investors. And I personally don't want part-time efforts watching over my investment. I want full-time efforts watching over my investment So you want to make sure that you have full-time efforts watching over your investment as well. So make sure that you do not invest with somebody who is a part-time operator, meaning that they maybe have a W-2 kind of a corporate job and they're trying to manage your investment at nights and weekends as a hobby. That's not what this kind of business is. It needs to be treated like a true business. And that's what we call it, the business of apartment syndication or an apartment syndication business, right? We don't call it, oh, it's a side hobby or a side business. It's a true full-time business and needs full-time hands and efforts on it. And the other thing about the operator is you want to make sure that they have skin in the game. So making sure that they are actually investing in a deal, in the deal with you. So if they don't invest, I don't invest. That's my rule, right? So that's, again, another one of those reasons why you would not want to invest in a real estate syndication is if the operator is not investing their own money into the deal. So I don't necessarily have a specific dollar amount. I mean, our group usually does about 5 to 10% of the initial capital required. We'll invest that as the GP alongside our investors. But at least I want to see at least a $100,000 co-investment from the GPs inside of or alongside the LPs or me as an investor, right? So you want to make sure that you're looking for an operator that has skin in the game. You want to make sure when they're watching your investment that they're also watching their own investment and their own return and their own money because they have their own capital and skin in the game. So that's number 4. Now, number 5, we're going to go over is do not invest. You should not invest in a real estate syndication company if they do not offer preferred returns. Preferred returns are very important, and you want to make sure it's preferred returns without a catch-up, because the preferred returns with the catch-up are usually too expensive and too rich for the investors to be able to get made whole at the end of the day. So for what you need to do, especially with the current condition of the market. And this kind of ties into reason number 5 or 6 here, which is making sure that you do not invest with a syndication group that underwrites for a refinance. Now, that doesn't mean that a refinance is bad per se, right? Refinancing is good. It's okay. I like them a lot. It provides a lot of return, but with our underwriting, we want to make sure that the refinance is a cherry on top of the returns and not contingent upon the returns, right? If the deal is so tight that you have to include a refinance, then it's too tight of a deal. And the reason why I said it ties into number 5, which is no preferred returns or the preferred returns with catch-up, is in order for a preferred return with catch-up to be able to make sense, you have to include a refinance because there won't be enough proceeds to be able to give to the investors as well as the GPs in order to make a catch-up work. Okay. And so this is something that you definitely have to watch out for. And I've seen it many times where if you see too many fees or a catch-up with the preferred returns, you usually are going to watch out for a refinance. And the refinance is usually going to be something that's going to be added on to be able to puff up the returns so that you can actually get it done. And so Steven's asking me to expand upon the refi warning. The refi warning is only from a projections and an underwriting perspective. So it's okay. And I like doing refis in a deal, but because refinances, there's so many different variables with them as far as the timing of them. So usually you have to, in projections, you have to say, okay, in month 24, we're going to do a refinance. It's very hard to project when you're going to actually do a refinance, and it can change the returns quite a bit, depending on when it can happen. Plus, you don't know where interest rates are going to turn out. You don't know what the terms are going to be. You don't know where any of that's going to line up. And so I've been in deals before. So just trust me, I've been in deals before where they have projected an underwriting a refinance, and the returns were not where they projected because the actual refinance did not get done exactly the way they had projected, and it throws off the entire underwriting. So for us, what we would like to see is we want to see that the refinance is a cherry on top. I want to still see that they're planning to do or will potentially look at a refinance at a certain point in time once they've done renovations or increased the rents or whatever it is and improved that community. But I want to make sure that it's not contingent upon the success of the deal, right? It's cherry on top, it's the sugar coating, it's the fluff, it's the froth, right? I want to make sure that it's not what makes the deal tick or what makes the deal actually work, right? So you have to make sure that when you're reviewing these deals, that the refinance is not included in the actual projections themselves. If they are, turn around as fast as you can, do a 180 and go the other direction, okay? Because you definitely want to stay away from that. Now, number seven will probably expand your mind just a little bit. And maybe you've thought about this, maybe you haven't, but there's one word that you need to be careful of. And it's actually kind of the one, it's two words really. It's of or on. This has to do with distributions and your return of capital versus your return on capital, right? If you're getting distributions and they're giving you distributions as return of your capital during the hold period, again, that's a reason why you should not invest with that group. And the reason why is because when you give returns of capital, it's reducing it's only benefiting the operator because they're going to get closer to their promote faster because the preferred return that is offered is based upon the unreturned capital contributions. So you might see somebody with a preferred return, but then they're giving distributions as a return of capital. So it's actually diluting your return over time because those preferred returns are calculated based on the unreturned capital contributions. So every month, if I'm giving you $1,000 back, your initial capital is being reduced by that amount as well. And some people will say, well, yeah, but it's better from a tax perspective because if I'm just giving you back your capital that you invested, you don't have to pay taxes on that. Well, eventually I will because my basis is also going down. And so when I sell, I'm going to have to be charged tax on that, right? But then you might say, well, yeah, but you don't have to pay tax along the way. Well, as long as you're doing a proper cost segregation study analysis on your properties, you should still not have any tax on that cash flow. It should be deferred because the depreciation benefit should offset any of the cash flows that you receive. So that argument is just complete baloney. There is no reason at all why there's any tax benefits for you to get return of capital versus return on capital. It just does not make sense at all whatsoever. Eventually, you're going to have to pay it because you're going to have that capital gains because the basis is also going down in the property. So whether you're reducing your basis or you're increasing your cash flows and taking depreciation benefit, your basis is going down the same way. So the only person that it actually benefits is the operator because it gets them closer to their promote. So all distributions should be classified as far as the cash flow distributions on a monthly or possibly quarterly basis. At passiveinvesting.com, we always do monthly, but when it comes to those cash flow distributions, they should always be classified as return on your capital. And when there's any type of capital event, whether it be a refinance or when you sell, that's when you get a return of your capital. And that's when your actual capital contribution, your unreturned capital contribution would actually go down at that point. Okay. So hopefully that made sense to you and hopefully kind of like went, boom, I didn't even think about that. But you want to make sure that you're watching these different terms and the languages in your operating agreements and in your PPMs as you're reviewing them with various operators. There's been some good operators that I thought I wanted to invest with, and I went to go review their PPMs, and I was like, there is no way I'm investing with this because one of these 7 things was there. And if only one of these is there, then I choose not to invest. So and especially with this distributions and when it comes with the distributions, as well as the modeling of refinancing and the no preferred returns. Those, I don't even get to the point of looking at a PPM if they already tell me right off the bat that there's no preferred returns. I just don't do that. I won't invest with it. And I highly recommend you not to invest with it as well. So that's all I have for today. I have one question that's come in here from the earlier questions that have already come in. If you have some further questions for me, feel free to type them into the chat box and I will spend as much time here as I can, maybe 5 or 10 minutes, answering some more of these questions for you as we're going throughout. So got a question coming in here from TK asking, what percentage of quote unquote skin in the game are you looking for from the operator? So again, I'm not looking for a specific like percentage or anything. What we do with our group is we usually do between about 5 to 10%. right? So when we're closing a large deal, we want to see at least 10% inside of the investment from the operator. At a minimum, though, I want to see at least $100,000 from the operator, right? From the GP side, I want to see at least $100,000 co-investment, no matter what the size of the deal. Now, obviously, the larger the size of the deal, I might want to see a little bit more than that, right? But at the very least, I want to see $100,000 investment, no matter what the percentage is. Let's see. Can you explain why you have skulls on your bookcase behind me? Those were investors that didn't act properly. No, I'm just kidding. But those are actually, you can see I have a skull right here. I got some it's like skeletal models over here. Those are actually from another business that I've had for over 10 years now, called shopanatomical.com. And we actually sell all types of skeletons and skulls and brains and hearts and all kinds of plastic models to colleges, universities, doctors' offices, and various things like that. So thanks for bringing that up. I appreciate that, Wyman. All right. Mark has a question about, can you talk a little bit more about preferred returns? So preferred returns, for those of you who don't know exactly what they are, they're basically the operator saying, we're going to give 100% of all of the cash flows to the investors up to a certain percentage, right? So 100% of the cash flows up to a certain percentage. In our group, we do 7%. We've done 8%, but that was a couple of years ago. Market's gotten tight a little bit, so it's actually at 7%. So we do a 7% preferred return. And then after that, that's when our promote comes in from the operator, where we do an equity split of, say, 70-30. 70% of the rest of the profits go to the investors, 30% goes to us as the operator for our kind of sweat equity, if you will, into the project. And the thing with the preferred returns you got to be careful of is the preferred returns with catch-up, which what I mean by with the catch-up is what many operators will do is they'll do 100% of the cash flows up to that 7%, but then they'll do a catch-up, meaning that before you get any more of the equity split, then the GP has to be caught up to that point of where they would have been if you had been doing 70-30 all along, right? And so that's where I'm saying it actually gets too rich, especially if you're 2, 3, 4 years into a deal. That's a lot of capital to get caught up to get the actual GP whole from that complete 70-30 split. So basically, it's basically doing away with the preferred return at the end and saying, yes, you're going to get the preferred return, but if there's enough proceeds left over, then we're going to get made a whole as if we were getting a preferred return or that 70-30 all along. And then the 70-30 will just continue on past that. So again, as you can see, it actually gives more proceeds to the operator when you do that. And the only way you can really make that work in this current environment of the market is to include a refinance in your project, or be able to have too many, or not too many, but being able to project an exit cap rate that is very aggressive, which is very hard to do, which is not hard to do, but it's not very conservative to be able to project a very, like a lower cap rate, a lot lower cap rate than what you bought it at, depending on the asset and then the market that you're buying in, and various things like that. Let me see here. All right, I don't have any other further questions here. And so I know some of you might be going through this and going, man, there's a lot of information here. I'm not sure if I was able to absorb it all. We're going to send out a recording of this. If you want to watch it again, you can. If you have any further questions for me about this, feel free to let me know. Would love to be able to would love to be able to talk to you further about your investment goals. Let's see if our group's the right fit for you. And if you want to do that, just go to passiveinvesting.com, fill out your information there. We'll be able to discuss your investment goals. Otherwise, we look forward to seeing you later this week at the MFIN Summit coming up. Make sure you don't miss that and you register for that as well. So thank you so much, and looking forward to seeing you later this week at the summit, and then also seeing you back here next week. The next week topic is going to be with Brandon Abbott, one of our other managing partners, and he's going to be talking about how to build a successful acquisitions process. So what is your criteria for multifamily deals? What is your method of building deal flow? Using people/team members to scale? Are you leveraging technology to save time? And then, of course, talking about the mindset when it comes to acquisitions as well. So we'll send out a link so you can register for this. So you can register for the next webinar coming up next week. It's going to be on Tuesday next week, 11 a.m. Eastern. Look forward to seeing you there. And again, also one more time, looking forward to seeing you at the MFIN Summit coming up this week. Make sure you go register and buy your tickets today.